Hello.
Three. Is Charmaine or anyone, is there anyone from the public that wishes to comment available?
Not that I'm aware of.
Oh,
And Ryan
Okay.
shaking his head no. Tasha as well.
Not where
Okay.
No one.
all right. Staff reports, the audit update, Charmaine.
Uh, No, those were the minutes from the
So we have
last
on the agenda, the audit update, which may just be that about what the, if you look at the agenda, after opportunity, we have staff reports, audit update. If we don't have it, that's-
Oh, I'm sorry. You're correct. I'm sorry. The audit update is simply that CLA is finishing up the audit now. I heard back from the partner that you all have heard from in the past. The partner from CLA, Vanessa Rosito, has had confirmed for me last week, Thursday, that we're in good shape to complete the audit. We fulfilled on our deadlines for getting specific pieces of data to them for them to finish by the 31st. And it has to be done because Bill is waiting for it.
So done by March 31st?
Correct.
And when is it due to the state with the, I know they extended it?
Well, it's due the 31st.
Okay.
And so that's when the extension was pushed to, and that's the final extension.
Now, does Bill need to do work after, before we submit it? So you
No,
have to do-
not before we submit it. He needs a final audit.
Okay, but not, okay, so we'll have it done by the deadline, which is good. Okay, all right. Approval of minutes for the February 14th meeting.
I move to approve.
I second, and it is approved.
All righty.
We'll go on to the old, well, we have no old business. For new business, since we do need to end at 6:45, and we want to give maximum time to Bill, but we also have to do number 2 of the proposed capital improvement adjustment. Why don't we we'll move that first to the agenda, if you're okay with that?
Yes.
All right, so Charmaine, we'll connect proposed capital improvement program adjustments for the current for fiscal year 21-22.
So this one is super fast, meaning that it's the grapple truck that was originally budgeted for in the capital budget. But due to a lot of things that we've all seen, the escalating costs of items has pushed us to a situation where we're a little shy of $20,000 to cover the full cost of the grapple truck. The savings from mowers and attachments and things of that nature provides us with an opportunity just to shift funds from that capital improvement item to the grapple truck. So there's no additional costs coming from the general fund or any place else. It's just a movement from one capital improvement project, approved capital improvement project, to another approved capital improvement project. So because we're moving items or dollars within the CIP, we need to make sure we bring this before the finance committee and also have the town council approve that.
Okay. Ben, any comments or questions?
No, if there aren't any from you, I can move to recommend it.
Yep, why don't we go ahead?
Okay, I move to recommend the, let me pull the language up, sorry. I move to recommend the adjustments to the capital projects fund as presented by the Director of Finance to the town council.
Okay, and the correspondence was dated March 7, 2022.
Yes.
All right. Okay, all in favor? Aye. And-
Aye.
Okay, we will make that recommendation tonight. And the second and last item is the debt service overview with Bill Lindsay. Thanks, go ahead, Ben, Bill.
So I'll just tee it up, Bill,
Yep.
if you don't mind. So Bill came before the finance committee a few months back when he was working on sizing the bond for the two major projects that are taking place in the town. That is the Mansfield Elementary School and the Mansfield Middle School roofing project. At the time, we were just getting started with the elementary school project. And there was still not so much that we didn't know how much the project would cost. We just didn't know kind of the timing and the reimbursement schedules that we would be looking at from the state. And the timing that we expected was that of an accelerated schedule, which it has not panned out to be. So fast forward to now, because I believe, I'm not going to speak for Bill, but in my mind, I thought we were going to be, getting to work on this exercise shortly thereafter. Once we got real good numbers coming in from expenditures to the project.
Which project in particular?
The elementary school project.
Elementary, okay.
The elementary school project. So the things were slow. I'm sure you've heard of the delays. The delays also were delays in paying for items, because work that was completed, and therefore getting those reimbursements from the state were delayed. So now we're at a place where we feel like we really need to make some good judgments and decisions. We've been in meetings with the owner's rep, which is Colliers, Scott Pellman, and our bond counsel. So Bill and I have been going, working through with the respective key stakeholders to come up with good numbers for him to be able to size the bond. I think that's your cue, Bill.
Okay, thanks, Charmaine. I'm going to share my screen if that's all right with everybody.
Yeah, of course.
Do I have permission, Charmaine? I do. All right. Okay, so I put together a little presentation here, and really, what I want to accomplish is two things. One is to kind of keep you or make you aware of or bring you up to speed on changes in the market since we spoke last August, and then kind of tell you what our plan is to address those, those issues, those changes here. And I'll start out by saying, it's the one thing that's difficult here is when we do these borrowings on a tax exempt basis, there are certain rules and restrictions that we need to comply with, and some of them are federal tax law, and some of them are state law, and they affect the timing of this and the borrowing amount a little bit differently. It's important to keep in mind under state law, the town can only borrow for its net share of the project costs. But the way the state runs school construction projects makes that kind of difficult because they don't reimburse you really until the end. They hold back 11% of their grant in a retainage. And they don't, and while they do pay for most projects during the construction period, it tends to lag. And so, it's hard to, it makes it difficult, especially on a project like this project that is fairly short in duration. If their reimbursements aren't timely, and unfortunately with this project, it took the state a while to set the project up in their system. And so they haven't been timely. It makes it difficult to get to what the town's net share is ultimately. And what we want to be cognizant of, or what we want to avoid, is the town over borrowing too much, and then the state in a positive way coming back and making reimbursement at a higher level, and then the town ends up with these extra bond proceeds that it didn't need, and it didn't need to borrow for. So that's kind of the fine line we're trying to walk here, and so it's important to keep that mind in mind at the onset of this discussion when we get into what our final recommendation here is. So the first thing I just wanted to do real quickly is just go over the projects, the two projects at a high level, just to remind you of what we, what we're doing. I know you're going to have at the full council meeting later on. My understanding is an update from the building committee and Colliers that'll get more into the weeds on this, but from a fairly high level. First, with the elementary school, right, it was a $50.5 million project. That's what was approved by the voters. The state is committed to provide 65.36% reimbursement on eligible costs. Originally, when this in the state's priority list, when they approved the project at 65%, that was roughly 33 million, assuming all costs are eligible. but in the real world, it doesn't work that way. There are certain costs that are ineligible. Based on that original estimate, if the state was contributing 33 million, the town would be responsible for 17.5. Happy to report, and you'll hear more from the construction professionals later on. The project's coming in under budget, which is great, which means the town's net share is going to be less than originally estimated. The problem is kind of triangulating on that number, because we've got some moving parts, and they are, as Charmaine alluded to, you've got some delays in the project. You've got some, a number of ineligible costs and change orders that have been made. Some have been approved and some are pending. So it's really hard to kind of narrow down that final number, but I'll get into what the plan is in a moment. The second piece is the middle school roof and solar project. Here it was roughly a 2.2 million if we round up total project cost. And I'm sorry, for the roof, and then the PV piece was another 600,000. The state here was gracious enough to have a 75% reimbursement, which would be just under 1.9 million. So the town share would be approximately 900,000. The problem, again, here with triangulating on the final number is for these smaller projects, especially these roof kind of projects, the state doesn't want to provide the towns with intermittent reimbursements. They want to do it all at once at the end. They want to get one submittal that they'll review, sign off, and then reimburse the town. Problem becomes the town has to front the money for the state's portion. And so that's another moving part, if you will, in this that's led us to what our final recommendation is. Now, in terms of the market, in terms of interest rates, so we've seen quite a bit of a movement higher in rates since we spoke last August, and I'll kind of walk you through as to why, just to try to put a number to what that rate move has been. These are tax exempt rates, okay? This is the AAA tax exempt benchmark that we use in the market. The yellow line is what rates were back in August of last year, and the blue line is where we are as of Friday. And so, we're about 90 basis points, nominally 90 basis points higher than where we were back in August, which is a significant move. And I'll kind of walk you through that, next. So first, before I talk specifically about tax exempt rates, I think it's important to kind of talk about what's going on in the world and in the larger economy, the U.S. economy, because that's really what is ultimately driving the tax exempt rates. There's something a little more specific to tax exempt market that I'll touch on next. But right from the beginning, at a high level, these things aren't, probably aren't a surprise to you. You've read about them in the paper, I'm sure. Really the main driver of rates is inflation, concerns over inflation. Okay. It really started with COVID-19 related supply chain issues and delays there. And that's really led to higher prices. Using CPI and the CPIU or the CPI urban number as kind of that measure of inflation, right? It really moved above 5% in May of 21. And then 6% in October of 21. And that's really when things started to get moving quickly. And then it went over 7% in December. And then the two prints we've had in this calendar year have been 7.5 in January and then 7.9 just in February. So it's rising, and it's what it's doing is it's forcing the Federal Reserve to start to tighten their monetary policy. The expectation is they're going to begin that at tomorrow's meeting. Okay, they have a 2-day meeting on the 15th and 16th, and the expectation is they're going to announce a 25 basis point rate hike on Wednesday when they have their press conference. And so it's important to keep in mind, if we go back to 2021, when inflation started to creep up and it hit 5%, people saying, well, and the experts, economists, we're saying, well, first it was no Fed increases in calendar 22. And then as inflation began to grow, it was okay, maybe in the fourth quarter of 22, maybe they'll have one or two. And then when we got to the fourth quarter of 21, really like December, when we started to get, hit 7%, now people started to get alarmed and they started to price in as many as 6 or 7 Fed hikes in this calendar year. And so that's really what's been driving taxable rates higher. And as taxable rates have gone higher, so have tax exempt muni rates. Obviously, the Russian invasion of Ukraine has not helped this. It created, again, further global supply chain issues, especially as it relates to commodities, especially as it relates to raw materials. And so that's really, again, another driver of inflation in the last few weeks. And obviously, the price of oil now is, hit 130, I think, last week. And so that's gone up considerably as well. So probably no surprises there as it relates to the overall economy and in inflation. But to talk a little bit about municipal rates and some things you may not be aware of, the other factors that we kind of have going, the other headwinds, if you will, that we have going specific to tax exempt municipals are, one, we've seen a much tighter correlation to taxable treasuries in this calendar year that we didn't see last year. And I'll show you a chart of that in a moment. And so as they've become more correlated, as the ratios have tightened, we've seen muni rates get dragged higher. Okay. And as they've been dragged higher, and the expectation is the Federal Reserve is going to start tightening, we've starting to see really some indifference on the part of investors or concern. Their demand has really started to wane. And the way we measure demand is flows, fund flows, municipal bond fund flows. So we measure what the inflows or outflows are on a weekly basis, and that kind of is our proxy for demand. In calendar 21, there were 45 straight weeks of positive inflows into bonds.
Bill, I'm sorry, I'm not sure I understand what an inflow or outflow is.
So what they do is they measure. Lipper is a financial services firm that measures the amount of money that goes into municipal bond funds on a weekly basis. And their measure was that for 45 straight weeks, for a total of almost $66 billion, so an average of over $1 billion a week, were going into municipal bond funds. So from a supply demand perspective, the higher there is a demand, the higher the dollar price is, right? So prices go up, and for bonds, as prices go up, yields come down. So as there was more money flowing in, investors had to put that money to work. They started buying bonds. With all that interest, bond prices went up and yields came down, and we benefited from that during calendar 21. But what we've seen since we've turned to calendar 22 is that in 8 of the 10 weeks in this year, we've seen money coming out. And so again, if demand is dropping, is falling, right, bond prices tend to fall as well. And when bond prices fall, yields rise. And that's why we're seeing, contributing to the higher rates on the municipal market is really the lack of demand right now.
That's pretty stark difference.
It is. It is, and it's fairly unprecedented, to be honest with you. And so it's made for a little bit of a choppy market. I mean, the market's still there. It still exists. There's a little more work in what we call price discovery and kind of finding the right levels. There are investors, but it's just a matter of finding what that right price is. So that's kind of what the exercise the market's been going through, the last few weeks. So I wanted to, give you a few charts, to help you visually understand what I'm talking about. So here, in terms of the correlation between taxables and tax exempts, the yellow line are tax exempt yields. This is the 10-year spot yield. And I'm comparing it to the 10-year US Treasury yield, which is a taxable rate. And you can see, through most of calendar 21, especially in the second half, they were pretty much 50 basis points apart fairly consistently. But as we get into calendar 22, you can see them start to converge. And they've really started to converge here in the last couple of weeks, where that ratio has gotten much, much tighter. And this is what's really been dragging municipals higher in the short term. And then to finally, this is the 20-year tax exempt spot yield. So again, just to visually show you, this is where we were in August. It was fairly flat in December, and it's really once we've hit January in 22, we start to see this this much sharper rise in rates. So kind of with that in mind, what we're trying to do here is manage interest rate risk is really what our objective is. And so what we're proposing here is to have the town issue bonds now in May, and we'll explain why May in a second, for what we think is a pretty reasonable expectation of the town's net share of the project cost for the elementary school. So we said originally it was 17.5 million-ish, assuming everything was eligible, which we know it's not going to be. So 17.5 million, but now we're thinking, listen, based on what the construction manager is telling us, it may be closer to 15 million. So what we're going to propose here is bond 15 million now, okay, in May of 22, and then issue short-term notes. Bond anticipation notes, or bands is the acronym we use, that will go out a year, and those bands will be in the amount of about 11.5 million, and they will cover the following pieces. So first, we're adding about $2.9 million, which would get us the delta between what we think the town's costs were going to be and what the original estimate was. And here, the hope is that the project gets completed on time and continues to be under budget. There aren't further supply chain delays. And if the town doesn't need this money, we'll pay the notes off with the proceeds a year from now, rather than bonding for them, which would be a violation of state statutes. We can issue short-term notes to insulate the town or protect the town, but we can't issue 20-year long-term bonds. So we're proposing a piece of this project be financed through notes. And then there will be another $5.9 million in notes that will cover the town's cash flow for the lag in the state reimbursement. So because the state set the project up late in their system and the town hasn't caught up yet in the reimbursement from the state, we borrow short term to cover the town's cash flow. And again, the idea here is we would not be issuing bonds for these. A year from now, the town will have then received the state reimbursement. We'll take those proceeds and pay the notes off. So no permanent financing. That's for the elementary school. For the middle school, we're proposing to finance short-term the entire amount. Again, expecting that we're going to get grants in, but knowing it's not going to come in until the project is complete and audited. So we will finance roughly $2.8 million of it now, short term. And in a year from now, if the town should receive the grant from the state, we'll pay down that portion of the note that represents the state's monies, and then we'll bond for the net share. All right. And so that, we're looking at something around $900,000, like, as I said, for that.
No, I'm sorry, the 900,000 is the interest, or is?
No, that's the 900,000 would be the town's share of the cost. So the construction costs, architectural costs, all the costs.
Okay.
And I'll show you, Peter, we'll get into debt service in a moment. I'm just trying to give you the kind of the overview of what we're doing here.
Thank you.
So when that $11.5 million of notes, short-term notes, comes due a year from now, the expectation will only need to bond 3.7 million or 3.8 million of it if we round up. And the piece of that would be potentially 2.9 million for the elementary school. Again, project comes in under budget as expected. We won't issue those bonds, but for now, to be conservative, giving you the worst case scenario, assuming that's here, 2.9 million, and then 900,000 for the middle school, again, only representing the town's net share. So that's the plan. And really our goal here is just to manage the interest rate risk to the town. But the expectation is that a year from now, rates are going to continue to rise. And we want to try to finance it at the lowest possible cost.
Okay.
So then, I'm sorry.
No, go ahead.
Okay, so now the debt service you asked about. So here's what the debt service is. So again, this is similar to what I gave you back in August. The first column is the contribution to the debt service fund, right? So the town has mapped that out in your budget document. And now then I layer in the 15 million of bonds for the elementary school, excuse me, right? And you can see what that debt service impact is. And then the short-term notes, the 11.5 million we talked about, that would be for both the middle school and the elementary school. That would have about $172,000 of net interest due next year. So that needs to be included in the budget. And then again, I'm showing you the worst case scenario here. If the town needed to borrow a total of over 17 million for the elementary school, which again, we're optimistic it's not going to be the case. We just can't, they can't commit to a number in the middle of construction where they've got, still $5 million of contingency that is, potentially not going to be used. So worst case scenario, we bond another 3.7, 3.8, and then you can see what the debt service impact of that is. So it's a combined little over 27 million in terms of cost. With the higher interest rates, it's about $3.1 million higher than the estimate from last August. Okay. But unfortunately, there's not much the town can do about that.
And just to review quickly, Bill, so even though the project costs, the construction costs are gonna, we think, run under budget because of the higher interest rates, then we're still gonna pay approximately $3.1 million more overall.
And yes, but that's worst case. That factors in, if I go back, that $2.9 million down here that we would be bonding. So if the town doesn't need the bond for that, and we're optimistic it won't need to, the interest cost will come down as well, right? We'll be able to pull out $2.9 million out of this total of 27 plus an additional amount for interest. My objective here was to kind of show you what the worst case scenario would be with the expectation that we won't need to borrow that much a year from now.
So Bill, is it, roughly ballpark, accurate to say that whatever we thought we were going to, the additional money we thought we would spend on the project that we would be responsible for, that it's kind of a wash by the time interest rates go up the way we're projecting, that the total amount, the cost to the town will be roughly the same with let's call it a lower principal, but higher interest rates versus higher principal and lower interest rates. Is it kind of a wash?
Yeah, I think so. That's a fair assessment. And it's also important to keep in mind that this is much less than what was originally projected back when the project was approved by the voters. So the estimate on annual debt service was 1.5 million annually for 20 years back when this was voted on. Okay. And so if you look at the orange column, we deferred principal in the first year to reduce the budgetary impact, but you could see that it does get over 1.5, but then drops down as we get, as the loan is paid off. And that was on average 1,510,000 for 20 years was the average number back, I guess it was at 2018. So I think importantly, from a larger, perspective, pullback perspective, it's less than what was originally conveyed to the voters.
And it's my understanding that there are going to be substantial savings in school costs that may actually equalize the cost of our annual payment. Is that correct?
Yes. Yes.
What energy costs?
That's what the superintendent is projecting.
All kinds of costs.
So I'm sorry, Bill, you mentioned that the overall, the impact will be lower than, the voters approved at the referendum. But but how does that, I'm trying to understand a few minutes ago, we were talking about the worst case scenario of $3.1 million additional to bond. So there's additional money to bond potentially. But you mean,
So if if the town needs to bond the full amount as I've shown here, it's a total of 17,875,000 is what it would be. Again, that's not what the likely outcome is, but that's the worst case scenario. It was originally projected that the town's net share was going to be 18,775,000. So the borrowing amount was $900,000 more at the time of the original referendum than what I'm projecting here. And again, we're cautiously optimistic it will be less. The problem is the construction professionals can't or won't commit to a number now during construction where they've got potential delays and the state has not approved all of the change orders. It's very difficult for them to commit to a number. And so if we don't have a final number, we had to backtrack and come up with another approach. And that's what we're presenting to you tonight. That's what the recommendation is that we have currently.
okay,
I gotta say, I don't want to be the one to explain this to the town council.
yeah, I don't think that's me either, unfortunately.
Yeah, I mean, I think from a procedural perspective, and I'd be more than happy to come and meet with them, as needed. In the resolution that was adopted for the borrowing amount, I believe that the mechanics of the borrowing are delegated to the town manager and the finance director. So it's not, the town council's function was, the full council, right? The function was to approve the initial borrowing. And within the resolution, it says, it's $50.5 million total. You can only bond net share per state statutes, and the particulars will be, determined by the finance director and the town manager. So there isn't a need in the sense that procedurally it has to happen. It as a convenience, if you would like me to speak to them and walk them through it, we absolutely not a problem. We can do that. One of the things to bear in mind is there's a little bit of a lead time on this. So I know, I said the expectation is that rates are going to go up, but we can't go out and borrow tomorrow. We can't just go to the bank and take out a loan. Unfortunately, we need to prepare an offering document or prospectus that we're going to use to sell the bonds. We have to get a bond rating. We have to prepare for that and prepare a rating outline. Not all takes, and we can't do much until the audit's done. So we've got about a 6 or 7 week lead time here, which is accelerated, to be honest. It's usually closer to 9 to 12 weeks, but we're kind of pushing to get this done as soon as we can. But there are certain things that have to be completed, and that takes time. So during that time, while we're developing the prospectus and the rating presentation, we'll refine the number as needed. And so if the state comes in and approves some of these change orders that they haven't done yet, that may give us confidence to reduce the amount of the notes and say, I don't think we need that 2.8, 2.9 million. Maybe we can knock it back by, 400,000 or 500,000. And that'll continue to happen right up until close to the bond sale in early May. But as it stands right now, based on what we know now, this is what our estimate is.
Okay, well, that's very helpful. So tonight, there's nothing we need to do.
No. So I asked Bill to come before the finance committee because these are critical steps that are going to be taking place like concurrently with the budget and everything else. And also so that the finance committee is aware that there is an actual financing plan underway and that the finance department is working towards that end. So it's simply informational and to make sure that that we tie off from what was discussed back in August to make sure that you don't have a gap in your understanding of kind of what he presented in August.
Okay. Ben, go ahead.
I would just suggest that if we don't have any decision to make, we won't have any decision to make in this process. We've already made the decisions that have led us to this point, but maybe as we are closer to preparing to issue the bonds, sort of towards the end of April, it might make sense, Bill, to have you come and do a similar presentation to the council, just so that, you know, there's only 3 of us here and the public doesn't watch these meetings as much, just so folks know that we're at this point in the process, and not ask us for any decision or anything, but take questions about what you just talked about here. I mean, it makes sense to me. I think it will be helpful for people to understand that even though interest rates have gone up, we're bonding less, and so the impact is going to be lower than what we expected last time we talked about this, but you'll have a better sense, slightly at least, right before the bonds get issued. So maybe it's a good agenda item for us at like our last meeting of April or something like that, if you're on target for your May 2nd date.
Yeah, I'm absolutely, I can do that. That's not a problem at all.
We have one vocal critic who has attacked us for spending much too much money on bonding, and I don't know whether she truly knows anything, but she knows enough to spark some alarm. So it might be a good idea to do this at some point. I'm with Ben.
Does late April or the second meeting in April's town council meeting sound like roughly a good time, Bill?
I think, yeah.
Well, May is better, or?
Well, no, we're scheduled to sell. I'm just looking at the calendar. We're scheduled to sell on the 3rd or the 4th. So I think that April meeting would be best. I mean, it all depends. If you would prefer it to be ahead of the sale, and then we can tell you what the expectations are, or alternatively, we could come back after the sale and if that May meeting and say, all right, we did this. This is what the final rate is. This is what the final debt service is. Here's the amount that we borrowed versus, that's I guess your preference. I'll say our expectation is we'll have a firm number, the end of April. And this, again, the approach isn't going to change. We may be able to reduce the notes here a little bit if we get news that the state has signed off on change orders. That may help us refine the number lower, but I fully expect that we'll have a firm number, end of April.
My feeling, Peter, would be to do this at so that meeting is on April
25th.
25th, and then if something drastically changes between then and sale, we'll have, we should be informed of it, but I think it makes sense to do it just in advance. And I mean, I think the important piece is the council's we're getting this as informational so that we and the public know what to expect in terms of our debt service impact, but we can't, there's no modification to this that the town can do. We've made our decision. The voters already voted on that decision. And so now it's just a question of keeping up to speed about what's going on. We have an agenda item about a different piece of the construction tonight. And so I think it makes sense. Peter, I have to.
Yeah, no, I think, do you have any other questions? Because I know you have to go, Ben, in order to get here.
Yes.
So,
No, let it go.
okay, so Bill,
Wait, one thing. Is that the meeting where we're going to finalize the budget?
Yeah, I think the second regular council meeting in April is your budget
Yeah.
approval day. Yeah.
It's going to be complicated that night. So
Maybe.
I think whatever you do has got to be concise.
Okay,
but Bill, all right, so we'll schedule it for, if we could schedule it for that town council meeting, second meeting in April.
okay.
And Bill, thank you very much for this. Okay.
My pleasure.
Thank you.
And do we have a motion to adjourn?
Yep,
6:42, we adjourn.
Okay, bye, everyone. See you soon.
Thank you very
Bill.
much.
Excuse me.